What's going on, guys? HM Crypto. You already know what time it is, so let's get to work. If you're new to the page, like and subscribe, hit the post notifications so every time I drop a video, you'll be the first to know. So, in today's video, we're going to be going over how the Fed monetary policy affects our investments, especially in the crypto market. So, let's hop right into this. All right, guys. So, in order to understand our investments and where it could potentially go, we're going to have to understand Fed monetary policy. So, we have to go back to 2020. So bear with me. So we have to understand what the Fed did. What the Fed did in 2020 was called quantitative easing. So it's a form of monetary policy in which the central bank, like the U.S. or Federal Reserve, purchases security from the open market to reduce interest rate and increase the money supply. The reason they did this is because, and during March of 2020, when nobody could work during the COVID lockdowns, where this they they sent out those stimulus checks. Remember the $6.5 worth, no, 6.5 trillion, excuse me, of stimulus checks. So everyone got $1,000, and that contributed to what we're seeing right now. But let me stick to the quantitative easing. So that interest rate. So interest rates were near zero. So banks were actually encouraged to lend out more money because money it was basically, this is what they called easy money or cheap money. When the interest rates are zero, they're just encourage more lending, and also the pumping of the money as well. It increased the liquidity in the market, so it encouraged more financial institutions to buy and sell, your favorite crypto and or stock. If I know there's some people who watch my channel, they invest in stocks as well, which is important, and real estate as well. So when since the Fed did this, yeah, you saw housing increased exponentially. I believe it was I can't even remember. I think it was more than 5% a month. I know houses were dumb like crazy. Whew. Like you see like a house that was worth 220 last year increased by like 50K. It's ridiculous. Anyways, so what this does was, it was easy money, and then we just kept printing, and then as you see, let's go to the S&P. I mean, not the S&P, Bitcoin. I'm HM Crypto, but I also invest in stocks as well. So you see the flash crash, March 2020. You know, 96 no 99,900 to 5,600, and then you see the flash crash. This is the easy money. Fed zero interest rates. There, look at this, all the way to 2021. Bitcoin hit 61,000. Of course, it crashed again. It's volatile. It's a volatile asset, and 61,000. That was like that was an all-time high of Bitcoin. And the S&P they trade as well. These trade similarly because financial institutions like BlackRock and Vanguard, they poured billions of dollars into, actually no, BlackRock, the largest institution, is actually worth a couple trillion. So that is impressive. They poured a lot of money into these projects, into these crypto projects, as well into the companies, our Fortune 500 companies. And that rose the stock market and the crypto market and actually the real estate market, because properties were hot in 2020 and 2021 exponentially. But everything, things just can't keep going up forever. This otherwise is unsustainable. We wouldn't be able. Can you imagine if this kept continuing? Houses that were once 220 that rose to like 350 in value would go. Well, if we continue with this road we're in, it would rise up 500 plus, and then nobody will be able to afford it. It'll be unaffordable. And this is the path to unsustainability. That's why we have this rocket inflation we have now. So as you see, the Fed went too far with the easy money, as they call it, the quantitative easing. So now, as we said, remember we had like I believe it was last month, it was actually 9.1 inflation. That's a core over core inflation. That's pretty high. And as you can see when you go out and buy your groceries and whatnot, they're expensive. They're expensive, way more expensive than they were last year. So they had no choice but to implement quantitative tightening. So what this does, and instead of injecting the money, he's removing the money. So he's reducing the balance sheet. It's called balance sheet normalization as well. So you basically take the liquidity out of the markets, a lot of liquidity. So how they added liquidity with quantitative easing, they added to the bond market, as well as the stock market and the crypto market. But now they're removing it. By the way, the bond market is the largest equities market. Securities market in the world. It's larger than the stock market and the crypto market combined. So doing this now restricts the money supply, and then it makes money more scarce. Which as you see, if you look at the dollar, it increases the dollar's value as well. So quantitative tightening, just think of quantitative tightening as just think of quantitative easing, just buy as you just keep buying and it keeps going up. Just think of sell. To just remove the excess liquidity, the excess demand. So they're calling this as well. It's also called demand destruction, because when things get so expensive, the Fed has to keep raising the rates. So people will take less mortgages, and it would crush the demand for mortgages, because who would want a 10% mortgage for 30 years? And when last year they could have got one near 2% or even near 0%, actually, is not zero, my fault, 2%. So it has to correct. Otherwise, we would have been on the path to would have had like Venezuelan money, and that's not good. So what does that mean for our investments? So right now, as you can see, we're in a bear market, but because institutions, when institutions know that events like this is coming, they sell a lot of their assets, and they flock to safety. So they go to bonds. So as remember what I was talking about the bond market, the 2-year and the 10-year yield. That's an example for the bond market. I'm gonna link an article as well, the CNBC article. That should really help you. That should really help. It not only has information about bonds, but just business in general. So I'll link you the CNBC website. So yeah, when they flock to bonds, because it's a guaranteed return. So let me go right here. Hold on. Excuse me, guys. So they have 20 years, and look at this. See the latest rates. The rates always update. They have 2-year, 10-year, 20-year bonds or 30 years, and then you get a fixed rate for each bond. It's like going to an auction. You bid for a bond, and then the highest bidder wins, basically, and then you get to put it in there, lock it up for 20 years, and then you get a fixed interest rate. So this bond is selling right now for 3.375% interest, but you have to it's a 20-year bond, and they have all different types of bonds as well. So yeah, it's a very, I'm not gonna get too deep into that, but just that's how whenever your investment, like let's say Ethereum, like your favorite investment is Ethereum, you wonder why, it was mooning, it was 4,600, and now it's crashed all the way down, and gradually came all the way down to now it's 1,600. Why is that? Well, the institutions were selling. They trade here and there in the ebbs and flows, but we're still in the bear market with actually, in a technical recession, because 2 negative quarters of GDP. So that affects your investments as well. Let's look at Ethereum, by the way, since I'm talking about it. And you see that I'm already on the max chart. So back in 2021, had a high of 4,600. Now 1626 right now, but it had a low of 993. So we're still in this recessionary market, still in a bear market. it's gonna get better in the long term, but in the short term, there's more pain to be had. So, guys, I'm glad you stuck with me to the end. So I hope you got value out this video. If you did, like and subscribe. Comment below. Tell me what you think of this video. Did it give you some perspective on your investments and your crypto investments and on your stocks? So let me. Oh, also, I really want to know, is anyone else in real estate? Because I am a real estate investor. So, whew, yeah, I'm getting hit hard, but we'll get through the other side. So, all right, guys, I'll see you in the next video. Oh wait, by the way, I'm not a financial advisor. You already know what time it is. I have to disclaim that. So, I'm not a financial advisor. Check the links below too for Webull, Coinbase, and crypto.com. They'll help you out as well. So I'll see you in the next video. Be sure to continue to build your foundation, and I'll see you at the top.